Yeah.
I'm not filing anything. I honestly don't even report anything to the IRS.
Okay, got it.
The paperwork that you will come finish these transactions with will be what the CPA needs to then fill it out and tell the IRS you did an exchange. And by using a qualified intermediary, you qualify for one of their safe harbor provisions.
Okay. And so the benefit really, I guess, in a nutshell, is that people can defer taxes on gains they've received from real estate transactions, selling real estate.
Correct. So that, yes, what you're getting when you do a 1031 exchange is you have what normally would be a taxable event, but selling a capital asset, but you're going to, by buying the replacement property and following the certain rules, you're going to defer that taxable event. Essentially just say, okay, I'm going to change properties, but I'm not going to recognize this sale from a monetary taxation perspective. And I'm just going to move the basis that I had in the original property gets moved over to the new property.
Okay.
So the tax isn't gone. It's not a tax exemption, but it's just, it allows you to get through this transaction without having to realize or pay the taxes now. And now they're in the new property. But you can do that multiple times.
It's not just a one-time deal.
Correct. Yes. As long
so
as
in 5 years, you do it again, you can do it again or whatever.
Yeah. So it naturally leads to an ever growing and expanding portfolio, because each time you, in order to get full deferment anyways, you have to buy property that's equal or greater than what you started with. So it naturally allows you to keep expanding your portfolio.
Okay.
So you could take equity that's been accumulated and pull it out of a particular property and then re-leverage it and buy two properties.
Okay.
Expand your portfolio. It's a very common use for it.
Okay. So let's say you netted $300,000, you could take 150 and put down on this property and 150 on that as an example.
Correct.
And mortgage those as long as the value is higher than what you've sold.
Yeah. Whenever we're talking about relinquished and replacement properties, it's cumulative. So if you have one valuable property that you sell and you buy two maybe lower priced, but collectively they're more than the one that you started with,
then you're good.
Counts. Yes.
Okay, good. Yeah, let's talk about eligibility.
Okay.
Because I know there's some really firm rules around eligibility and things that people need to know about around that.
Yeah. So the primary eligibility is that the property was held for business or for investment purposes. That's the exact line from the statute. Of course, there's a lot of interpretation in that. So one way to look at it is, well, what doesn't qualify for those? Primary residence, if it's something that you've lived in, and when I say lived in, I mean up to the point that you're selling. It is possible that you could have lived in a property at one time as your primary residence, moved out, rented it for a long enough period of time that now it qualifies for an exchange, even though it started as your primary residence.
Got it.
These labels aren't fixed forever. They're relative to the time frame we're talking about of the sale. So primary residence does not count. And then also, just if you own a second property that maybe isn't your residence, but you're also not really actively doing anything with it. You're not running a business on it. You're not leasing it or doing anything income producing on it. That doesn't qualify either, because it's not viewed as being held for investment. So it is important that you have sort of some aspect of how you used it as an investment property to validate it.
Okay. Interesting. And also you mentioned, I think it's also good for commercial properties too.
Oh yeah, absolutely.
It's not just
in most commercial properties, it's pretty obvious. They're either rented out or the actual business is running on the property as well.
I've been in the residential space so long, I just think about houses, but you can sell buildings or and let's talk about like kind, because there is a is that a term that something that has to be like kind that you're purchasing?
Yeah, so the term like
that's where it gets a little confusing for me.
Yeah, that's one of the more confusing things, and honestly, today it doesn't have as much meaning as it used to, because the 1031 provisions used to apply to more than real estate. There were actually some components of it that applied to personal property. The 2017 tax reforms got rid of all the personal property.
What year was that?
2017.
Okay.
During the Trump administration, the last major tax reforms they did.
Got it.
So it narrowed 1031 down to be just real estate related. So like kind used to have a little more differentiation, that real estate was not like kind to some of the personal property components of it. So you couldn't exchange between those two. Now, really all real estate held for business or investment is like kind to all other real estate held for business or investment. So a lot of people want to say like kind means, well, if I had a house, I have to buy a house, or if I had an apartment, I have
That's
to
what I
buy an
always thought
apartment.
too.
All these are all marketing terms.
Yeah.
Single family,
Right.
multifamily, duplexes, commercial, industrial. It's all just marketing. If the property is held for business or investment, it can be exchanged for anything else that is held that way. So the nature of the property doesn't really matter. It's how you're using it.
Okay. So let's assume for a minute that I have a property and I want to sell it. It's a residential, let's say it's just a residential home and it has been a rental. But I want to take that capital, that net, if you will, and buy raw land. Is that acceptable in an exchange like this? It's not going to be producing anything per se.
It would depend on what you do with that raw land.
Okay.
Like raw land itself is not in any way excluded, but the question is, how are you holding it for business investment? So being in Texas, a very common way is leasing it out for ag or hunting or,
Right.
some other uses like that. If it's more of an urban property, parking lots, food trucks, any of these
Okay.
things, that makes it investment.
Yeah.
Usage.
Tiny
You're doing
homes or
something with
whatever.
land. Right.
Yeah.
Yeah. So there's a lot of maybe non-traditional ways of looking at that, but just owning the land itself is probably going to be an issue because you haven't really had like an active investment component of it.
And who's going to be an issue with? The IRS?
Whenever I say a potential issue I'm referring to if audited, these are the questions the IRS is going to ask, because it's quite often that, you can put the numbers down on a form, but they don't ask a lot of questions on that form. It's just numbers that go on there. So really all of this comes down to, if audited, can you and your accountant or your tax attorney support what you filed? And that's true of any time you write your taxes down. I mean, you're putting numbers down there that you have to be able to support if asked.
Exactly. I just told you today, I just filed my 23 taxes today. So I got that out of the way. But and also about deadlines, I know that, and you mentioned sometimes well, let's talk about the deadlines, number one, and then talk about how that works and why that's so important to people know.
Yes. So the deadlines, and these are the biggest hurdle to a 1031 is there's a 180 day maximum time frame to do an exchange. So from the day that you sell your relinquished property,
it starts on that day.
Well, I refer to that as day zero, as your closing day.
Got it.
Starts counting the next day, and anything that you purchase as replacement property has to be fully purchased and completed in 180 days. That's there's really no variance on that other than national disasters, like right now with the hurricanes. Some of those areas
give you some grace there.
If there's federal national disasters, they'll give extensions.
Like in North Carolina.
Yeah, North Carolina, Florida, wherever those things are going on. It happened here in Austin when we had the ice storm.
Sure.
And that it applies to a lot of things besides 1031, but that's one way you can get an extension. I can't give an extension if it's not for one of those federal emergencies. They're fixed dates.
Now, how do you find out about those things? Just curious. I mean, how would you, or do you even find out? Do you care?
Well, being in the business, I have trade groups and things that are alerting me.
So this area is going to
like
give you
this disaster got declared.
Okay.
But in a general sense, you can research it through the government websites and see if there may be an applicable extension that got put in there.
So 6 months in general.
Yeah, normally the 180 days. And within that, there's a 45-day deadline, and that's a little bit more abstract deadline. It is definitely fixed. I can't change it, but what it is within the first 45 days, you can buy. So you can buy immediately, like you can sell and buy the same day, or you can buy anytime during that 45 days. But if you get to the end of 45 days and you haven't bought everything that you're going to buy yet, if you want to keep your exchange open beyond the 45 days, you have to identify, which is essentially just writing down a list of properties. And then your exchange stays open beyond 45 days, but it's narrowed down to only the properties on your list. And of course, there's some rules about that. The identification has to be signed. It has to at least adequately identify what property we're talking about. So usually an address will work, unless you're talking about rural land where there's maybe no address, and it might be 20 acres carved out of some bigger piece. So whatever's the appropriate way to describe it, it has to be signed and it has to be provided to the QI or somebody else.
The QI meaning
qualified intermediary,
which is you.
So yeah, when working with us, that would be us. So really that goes in our files. It validates that you followed the rules. And from there, beyond day 45, now the exchange is still open as long as there's available money and available properties on that ID list.
Okay.
There are some limitations on how many properties you can put on there, because I always get that question of, well, I'm just going to identify everything in this county as possible. But you can't do that. So the simplest rule is what they call the 3-property rule. You can put the first 3 properties on a list, no problem. If you want to go more than 3, then they say, okay, well, we won't cap you on quantity of 3, but we're going to cap you on value. So the next rule is called the 200% rule.
Got it.
So they look at what you sold, the market value, and say, okay, double that, 200%. And then you can identify as many properties as you want, where their values cumulatively go up to 200%.
Okay. Total.
Got
it.
And
so if you sell a house for $500,000, you could only go up to $1 million?
On that well, if you're applying that rule of identification, I could identify a single house for any value, or even 3 houses for any value.
Got it.
But if I want to go do more than 3, now I've gone into where the rule applies a cap value, which in your example would be $1 million.
Okay.
And if you look at it, like how much money you have, sometimes those rules kind of just make sense. There is a third rule called the 95% rule. Just to be clear, there's one more rule. It is very dangerous because it's an all or none. It basically takes all the handcuffs off and says you can identify as many as you want with no limitation on value, but you actually have to buy the equivalent of 95% of the value of everything you identify. And if you don't, the whole thing's failed.
The whole thing's out.
So
wow.
I have not found a client yet that has had a good rationale for wanting to use that rule.
That'd be crazy.
And I've been asking other QIs, like, please give me an example of somebody doing this successfully, and I can't find one yet.
Can a client buy a contract, I should say, on a property before they sell their current property?
Yes, contracting. The exchanges don't really deal with contract dates.
Okay.
So whether or not you've got a contract for something that will later be your replacement property, that's actually great. If you know what you're going to buy before you've even sold, then
if you've dialed that in, you're way ahead of the game.
You're way ahead. You kind of know. One, I know what I want to buy. I've actually got a contract. I know the dates and the numbers, so that all comes together. So that's actually probably the best way to do it is know what you want. But of course, you have. And this is true whether it was a 1031 or not. Anytime you write a contract to buy something that is really contingent on you selling something, you have to make sure you have contract protections that if something doesn't sell, you're not locked into a contract.
That's right.
That would be true.
That could be a little risk there.
Not.
Yeah.
But it definitely comes up in the 1031 context, because they're worried about that timeline. So they might commit to a contract sooner, a purchase contract sooner, because they want to make sure they've got it lined up to get it done quickly.
Sure. Yeah. I just didn't know if you could contract prior to. That makes a lot more sense. And what are the penalties if, let's say, this 45-day thing doesn't happen? You've identified 3 properties and you haven't bought them. The deal's over?
Well, the significance of that 45 days can come up in several ways. One, it can be also your first out. So when you start a 1031, I always tell people, you're really not committing to do a 1031 yet. What you're doing is you're buying the first 45 days. So for my fee, which is $1,200 to set up an exchange, you paid $1,200. You bought the first 45 days of time to go look around. If you don't find anything you want, or you just change your mind and decide you don't want to buy real estate, your first exit point is day 46. Just simply don't identify anything. The exchange will have no identified property, so the exchange is effectively over. You get your money back. It cost you $1,200. But there's no penalty. In fact, the IRS, you're not going to report anything to the IRS. So really, there's really, other than the expense, nothing that happened. It's but you had that 45 days to think about it. Whereas if you don't involve the QI, and a week after you sold your property, you see something, you're like, oh, I could buy this. I can't do a 1031.
It's too late.
You took the money. Yeah,
it's too late.
You have to be in front of that sale. You cannot receive those funds.
That was my point. My next question is around the funds. So the funds have to go from closing to you.
Correct.
Okay.
Yeah, one of the biggest principles of using a QI and what the IRS has allowed is in this procedure is that you don't get constructive receipt of the funds. So, as a third party, we hold the funds for you. They can only be applied in these scenarios. They can be applied to qualified replacement property, or they can be returned to you at the appropriate time if the exchange doesn't work. And that's really what the role of the QI is. Like we sign what we call an exchange agreement. It's a contract. But if you look at what's in that contract, you're engaging us to mimic the IRS rules. So our contract has all the IRS rules in it saying, we're going to follow this. You're agreeing to be bound by it to allow me to hold your money and to be restricted from it. I'm agreeing to administer this contract in a way that matches the IRS. So that's the IRS compliance component of it, that later when you file your taxes, you say you worked with a QI. It's based on us having signed that agreement. That's really what makes me a QI, is that we signed that agreement.
Got it. Interesting. And so let's talk about being a QI, this qualified, what's it again?
Qualified intermediary. There's also sometimes you hear accommodator. There's different industry terms around the country. I go with QI. I like that one.
But going back to this 45-day real quick, what percentage do you think of the people that hire you go through the transaction as far as the 1031? Like 90%?
Fully completing purchases? Right now, it's fairly high because it's pretty easier. We're in a more balanced market. We talked about this earlier in the show. Yeah, that for a 1031 to work well, you need a balanced market because people have to sell, but they also have to be able to buy. A few years ago, particularly here in Austin, when it was such a hot seller market, people would start an exchange and they couldn't get anything bought, and they would get discouraged, and then identifying would be a problem because they'd keep coming to me with more and more properties. Like, I'm making offers, none of them are getting accepted.
This is terrible.
I'm getting outbid, and each time they do it, it takes like a week. So they're burning time putting offers out. So that was more difficult. So I probably had a higher failure rate
just because of that, the market itself.
Right. Yeah. Because also the moment people put something on the market, it would sell. So they didn't get a lot of lead time to really go.
That's right.
They were so quick and difficult to buy. So it actually works better when you can do both and have a reasonable expectation of what's going to happen.
Yeah, for sure. And I was going to talk about something around that. I just lost my thought. But let's talk about mistakes, because I know that when you start dealing with the IRS, if you make a mistake, it could be pretty bad. So let's talk about mistakes people do make. Is it around this timing thing primarily?
Well, mistakes, yes. If you don't, you can do things where you unintentionally maybe tie your money up because you put properties on the ID list that maybe you really didn't want to buy, but yet they're still on your ID list. And if you have money and ID'd property, that could hold you to the end of the exchange.
Got it.
So I think strategizing, and this is what we do. We get on the phone with people around day 40 and have these conversations. All right, what are you looking at? How solid is it? Do you have any offers out? What do you want to do? Because I want to make sure they understand the implications of going past that 45 days. The other mistake that I've seen people do a lot is underestimating what they're going to buy. For example, I had somebody sell, I'm just for round numbers, called $1 million, but they swore up and down that they were only going to put $600,000 of it into real estate, that other 400 that they wanted. But so they took the money out at closing. They only put 600 in. They took 400 out at closing. So right there, the moment they took it, it's out. So it's taxable. They've got 600 in the exchange.
Got it.
Well, then they went looking for properties, and they were doing that where they were going to buy some single family houses. So they were about 300 each. Well,
they wanted their money back, or
no, they went and found two of them, but they were a little more than 300 each, and they ended up spending 700,000. So I had 600,000 in the exchange funds, tax deferred. They had 400,000 in their bank account, taxable, and they ended up putting 100 back into those purchases. I told them in the beginning, I said, if you want money left over,
put it all in.
Put the $1 million in, or at least put more than a margin above where you say your budget is.
Sure.
Their problem was they put in exactly what they said their budget was, and then they went over their budget. Had they
that's not unusual.
Either put it all in or even just some margin above that, then they would have gotten the money back in the end.
Right.
There would have been that delay, but that extra 100,000 they ended up spending would have been tax deferred.
That's a huge point. That's a huge point. I never thought about that.
They talked about it later. They're like, I know you told me not to do this. It went exactly like you said it was. And I said, well, it's a little bit predictable. We always go over budget when we're shopping.
Yeah. So once the money comes to you, it sounds like you give them some counsel along the way too. I mean, you're talking to people, and you're saying, here's the deal.
That's the differentiator in our company. Is there's companies that do this of all sizes, from small boutique shops up to large national companies.
Sure.
And a lot of it is just paperwork. Sometimes title companies, they don't directly do it, but they'll sort of take care of getting it done for you by using one of these big national companies that's affiliated with the title insurance companies. But there's not a lot of strategy involved in there. You know, it's like, you know, you do your own research and you fill out the paperwork, and it's all, you know, perfectly IRS compliant.
Right.
But nobody really sat down and talked to the client about what they're doing and what these implications of these things are and how it could be done with just a little tweak here or there. And that's really what we do. You know, being an attorney, I'm used to counseling people on these things and having those conversations and the what if scenarios is to me is part of the service that we provide.
That's awesome.
You know,
and that speaks to, we want to make sure people know how to get a hold of you. So tell the audience, you know, if they want to reach out to you with questions, and, you know, what's the best way to do that?
Yeah, absolutely. Of course, we have a website. It's 1031 Texas, but it's actually the numbers 1031texas.com. They can reach us there. We're on LinkedIn, of course. And then you can reach me directly. My last name, Gorman, Gorman, at 1031texas.com as well. Awesome.
And what is your territory? I should say territory, but where do you work mainly? Austin, Texas, Central Texas, Texas itself, the country?
It's really nationwide, in the sense that because we're talking about a federal IRS law, people can buy and sell in any of the 50 states. My customer base, being from Central Texas, is generally somebody that I've met or come across here in Texas, but they might be dealing with property anywhere. You know, I think I counted up the other day, we've had closing transactions in about 27 or 28 different states. Usually it's Texas and some other state, but as we expand and repeat customers, we'll get people that are buying and selling in Colorado. That's a popular one. You know, Texans love to go up to Colorado.
Sure.
You know, New Mexico, Louisiana.
More so than Ohio.
States. Yeah, more so than Ohio. We get a lot of California people that are moving to Texas, and some of them have California properties that they'll divest and want to
bring the money here.
Yeah, which is actually a great use of a 1031.
Absolutely.
Relocation is something, it allows you to reset your location of your portfolio without taking that tax hit in the middle. So you can make a lateral change, get all the money. Maybe if you're an active landlord, that might be important that you're near your properties, or you just, you know, you think Austin's the hot market and you want to get your money invested here as opposed to somewhere else.
Sure. And what are some scenarios where it would not be a good strategy for an investor? Can you think of anything where it wouldn't work?
Well, it's probably more a matter of degrees. Like I always tell people, not every exchange is the same. Just because you have an expensive property doesn't mean you have a huge tax burden. Like, to understand the value of an exchange, you have to understand, well, if I don't exchange it, what is this going to cost me? What is my tax burden without an exchange? And that's and it's also not an easy answer. It's not something I can give a client an answer to, nor would I, because I'm not their accountant. But you go to your accountant, figure out what your basis is. And that is a relative question, you know, what you bought it for, what you've done with it over the years, have you taken depreciation, all of those things go into that, and find out, okay, if I sell this year and I report it as normal capital gains, I can tell you, you know, capital gains is probably 20%. There's also a 15% bracket, depending where you're at. There's net investment income tax, and then there's depreciation recapture. All of those taxes could apply in there to give you a total tax burden. Once you find out what that number is, then that's the value to you of the exchange, because that amount of money is what you can put right into your next project without having to do any holdback or you know, reduction of your next investment for that. I've heard it referred to as a tax-free loan from the government, because they're letting you take what otherwise would be your tax burden and invest it. And even if you pay those taxes later, all the growth you got off of that chunk of money being invested is what you gained. Yeah. Particularly if you leverage, you know, if you have something where you had a lot of equity and you take it out and you re-leverage it, you can get, you know, 5 times the buying power to applying like an 80-20 loan to it. So it really, it takes 20% growth to double your portfolio with an exchange, because you don't have to hold anything back. Right. Now, I'm not accounting for some sales expenses in there, but the basic math is every 20% you can re-leverage and double.
Well, listen, the time flew by as I knew it would. I mean, we're just kind of getting warmed up, but we are out of time, Jason. And I appreciate you again coming on the show. And